Rocking retirement isn't just about the numbers. It's about creating a life that you can be proud of. And I invite you to join me on May 13th, where we're going to show you how to create your non-financial retirement plan. You can learn more at livewithroger.com. Do you want to have the confidence to truly rock retirement? Well, I'm going to show you how on the Retirement Answer Man Show. Hey there, welcome to the show. My name is Roger Whitney. I am your host. I'm glad that you're here. We got a really big show. It seems like it's such a weird thing to say. A really big show today, but we have a lot to talk about. We got transformation. We're going to define separately managed accounts so you understand what those are. We're going to answer listener questions on 401ks and discount rates and long-term care. So we do have a lot going on. It is going to be a really big show. So why don't we get started? One quick announcement before we get to the show, and this is about the Rock Retirement Club, our online community, but also our online course. A course you can take on demand that will walk you through step by step, creating your retirement plan so you can answer the questions. When can I retire? How much can I afford? We have an on-demand course that will walk you through that. But what I want to tell you about is we have a new member of the Rock Retirement Club team joining us, Andy Panko, who is founder of Tenon Financial. He has 20 years experience in corporate finance. He has a CFP, an MBA. He's an enrolled agent, which means he can do tax returns. And he's coming into the club to host meetups with me and create courses on taxes in retirement. So I'm really excited to have Andy join us on faculty with the Rock Retirement Club. Not just because of all that cool stuff around taxes and retirement, which is important, but Andy is a really nice guy and fun to be around. So you can check out the Rock Retirement Club at rockretirementclub.com. That's where you can build your plan and get the inspiration and the tools you need to really rock retirement. Transformation. We're going to do a sort of what's that mean segment here. Transformation. What is that? We were doing a book study in a group that I am in, and we were talking about transformation. And the definition is it's a dramatic change in form and appearance. So it focuses on the physical sense of it, but there are a lot of transformations that we make in life that aren't just simply physical experience. You go from a single person to a married person, from a married couple to a parent. You go from a worker to in retirement is also transformation. And as we were going through this book study, I was jotting down things that the presenter was sharing, and man, this applies. So I thought I'd just share it because I was thinking about it. So what triggers a transformation? Well, in the presentation I was listening to, one is there's the self-starter. I am going to transform in this way, in this area. Like I'm going to learn how to ride a bike, and you just go out there and you just start, right? That's a trigger to create this transformation to becoming a non-bike rider to a bike rider. Nicole Mills, by the way, did this just a few years ago. She didn't know how to ride a bike, and now she does. Another trigger for transformation is a life event, like the ones that I talked about, and retirement is a major life event. So that could be a trigger that is going to cause you to really transform your entire life more than a lot of us really acknowledge. That's why we talk about it on the show. And then the last trigger is the marathon, right? Where you're just gradually changing over a very long period of time. So if those are the triggers, how does transformation happen? Well, according to the author in the book study, and I can't recall the name of the book off the top of my head. I'll have to get it and put it in Chick Shot Saturday, which is our weekly email. So how do transformations happen? One analogy is clay, right? This is more the self-starter mentality of taking clay and intentionally shaping it into this new form. And that is definitely what we like to talk about here, which is the intentionality of using an agile methodology to intentionally shape that clay. And then another way it happens is through the butterfly, like a butterfly metamorphosis. You just sort of come out of this cocoon, and that's more the marathon way that it happens. It's a gradual process that just sort of takes its course. And we believe in shaping the clay as a self-starter, and sometimes life throws you into that because in retirement, there's a lot of transformation going on that's beyond just simply the financial. And so that's why next month in May, we are going to spend the entire month focusing on creating a non-financial plan to sort of identify the kinds of transformations that are going to occur so you can intentionally shape the clay yourself to navigate that transformation. You can learn more about that at livewithroger.com. Now, let's go talk about these separately managed accounts. Is that something you need to even think about? So this month in our main segment, we've been just defining financial vehicles. We've talked about mutual funds. We've talked about exchange traded funds. This week, I thought I'd talk about what's called a separately managed account, an SMA. And I've encountered a few of these recently. So I thought I'd explain what they were so we can define, as we're implementing our investment strategy, what kind of vehicle we need to use. So first off, what is the basics of a separately managed account? Well, now that we know what a mutual fund is and an ETF is, a separately managed account is similar in that you're buying a portfolio that is managed by a third party, whether it's because they're mimicking an index or they have a particular investment strategy. You're basically assigning the management to this money manager who is implementing the portfolio that you've hired them for. Like if you buy a growth mutual fund, you're hiring that investment manager. If you're buying a iShares Russell Value ETF, you're buying the manager to implement the index. So essentially, it's the same from that perspective. Where it becomes different than an ETF or a mutual fund is with a separately managed account. Literally, what you do is you open up an investment account at a firm, and generally these are done through advisors. So say you open up an account at UBS, and then the advisor says, we should use XYZ Value Manager to implement that portion of your portfolio. So you move money over to that separate account that you've set up, and then contractually, you assign XYZ Value Manager in this example to build the portfolio of value stocks that represent their strategy. And they actually do it in your account. They're buying all the individual stocks that you own in your investment account. And then when they decide to sell one or buy one, they trade your investment account and buy stock A and sell stock B or build a position. So it's essentially a mutual fund that's totally unwrapped, that you own every individual position in that account in your portfolio. And so that's essentially what a separately managed account is. It's an unwrapped mutual fund where the manager, rather than managing one mutual fund, they're managing all these individual accounts based on whatever models that they run. And so some of the advantages that are suggested with this strategy is, one, you get access to institutional managers that don't manage mutual funds. So you can only access them and their expertise through this structure. So that's one of the advantages that's talked about. Another is the ability in a separately managed account, because you own all the individual positions in your own account and not in some wrapper, you can say, hey, I don't want to own any, say, tobacco stocks. And even if the separately managed account strategy or the manager has that in their core portfolio, if you say, okay, I get that you have that in your core portfolio, but I don't want any of that in my account. So you can set some restrictions on what is allowed in it or not in it. And it could be because you don't like tobacco, but another use case for that might be, let's say you have a lot of highly concentrated position in a large technology company that you happen to work for, or for whatever reason. You could say, I want you to implement your strategy, but don't buy any more of this kind of technology. Don't buy this individual company or any company in that sector because I already have that covered outside of your account. So it gives a level of customization to the rest of your financial life. Another potential advantage is that you can better control the realization of gains and losses. So as an example, towards, say, the end of the year, if you were in a mutual fund, if they do a lot of trading that are going to generate capital gains, and you don't want any capital gains, well, there's nothing you can do about it with a mutual fund or even an ETF, because you can't tell them what to do. But with a separately managed account, because you hold the securities at your level, you could say at the beginning of the fourth quarter, tell your advisor to instruct the investment manager, hey, don't realize any more gains for the year. And that will stop them from doing it in your account. So you have the ability to do that, or conversely say, hey, go realize as many losses as you can because I need those because of this other stuff I have going on. So there are some advantages potentially to having a separately managed account. Now, what are some of the disadvantages of this type of structure for investments? Well, a lot of times there's less options because mutual funds and ETFs are tens of thousands of them. Separately managed account managers, it's a much smaller group that you have access to. Their minimums are generally higher, 100,000, 500,000 to $1 million for one strategy. So if you are doing an asset allocation and you have, say, 5 different targets of large cap value, large cap growth, small cap, international, and bonds, you would have to buy a separate account manager for each one of those and put them all together. So you're going to have enough to hit the minimums for all of those different asset classes. Their fees, generally they can run a little bit higher. There's some argument whether that's the case or not. What I have found is the big disadvantage of a separately managed account, and I've used them in the past, I haven't in a long time, is just simply the complexity. What do I mean by complexity? Well, one is you're going to have all these separate accounts with these separate managers doing their own strategy. Each one of those strategies is going to have a portfolio of anywhere from 40 to 100 different stock positions. You're going to be seeing every single stock or bond trade come across back and forth, which is going to create a lot of paper. It's not unusual for one separate account manager when you look at the statement that you get from the account to be 40, 50 pages. Because you have all the individual positions. It's unwrapped. So you get to see everything. And that seems like it's a good thing potentially, but you got to review and monitor the 50-page report rather than the 3-page report. And you get to nitpick, why did they add to that stock and sell this stock? And you get to see positions that are very small relative to the whole because of all the diversification going on. It's not unusual to see positions that are $1,000 or $2,000 in a portfolio with $500,000 in it. So you get to see all this nitty gritty stuff, and it just creates complexity. And then your 1099s, if it's in a taxable account at the end of the year, there's a lot more tax accounting involved. So it creates a lot of just mind junk in your head by having to look at all this, but also can create complexity from a tax perspective. So who are these most appropriate for? In my humble opinion, almost nobody, unless you're really into the $20, $30 million portfolio range. You're likely not going to get near as much customization as you think you're going to get in these type of strategies. It's not worth the hassle. There's not enough incremental value potentially being added to justify the added complexity. I say that these are generally marketed to investors with $500,000 and $1 million to $2 million all the time because there's a cachet to it in the sense that you can't get access to these on your own, these strategies on your own. And there's a cachet to saying you get access to institutional money management. In my perspective, most of that is smoke and mirrors. It doesn't add enough value for the average investor of someone under, I'll be nice, say $10 million. No need to go down this route. When you have other vehicles and other tools you can use to keep it a lot simpler and to be able to manage some of these things. So that, my friend, is what a separately managed account is. You are what the show is all about. So I'd love to hear your questions and talk about the issues that you're thinking about. So that's what we're going to do here in this segment. If you have a question or a comment that you want to share with me and perhaps on the show, you can go to rogerwhitney.com/Ask Roger, and you can send us a note or leave us an audio message similar to what Dennis just did. Let's hear from Dennis.
Hi, Roger. My name is Dennis, and I've been listening to your podcast for a year and a half, 2 years now, and I've thoroughly enjoyed it. I was listening to the podcast today from this week with you and Fritz and realized that since I retired in October, I've been taking on more and more responsibilities for contracting work so that I could be working more hours now than I did when I was working full time. And actually, this isn't a question, but a big thank you, because listening to you and Fritz today, it made me think, what was I working and why was I doing this contract work? And it was really more about my ego and not about needing the resources. So it made me reevaluate and actually take the time to say, I'm only going to work to fund the extra things that I want to do for the next year or so. Camping gear to hike the Appalachian Trail, new power tools for the wood shop, because working with wood and creating things down there, that is what gets me up in the morning. So again, I just wanted to give you a big thank you and take care. Keep up the good work.
Well, Dennis, I am thrilled to hear this. It's amazing how easy it is for us to recreate what we just left. We do it almost subconsciously. We're used to being busy at a certain pace and being valued in a certain way from work. And it's like when it goes away, if we're not careful, we just recreate it in a different form so we can feel comfortable again. And you recognize that. And now you've framed why you're working to help fuel the things that really do light your fire. That's awesome, Dennis. As you say, you were doing more consulting work, and it's not uncommon, at least for me, to see people working as much or more and making more money with the same company they just left oftentimes because of the institutional knowledge and wisdom you have that is so valuable. And you don't really realize how valuable it is until the situation presents itself. I like how you compartmentalized it to where you're using it as a tool to fuel something that really does excite you, which is woodworking and camping. That's a really healthy way of understanding why you're doing something so you can create a boundary around it. Now, that's a really good word, boundary, is creating boundaries for yourself. In your case, Dennis, you do this for work. I've seen people, and we've talked about it, that do it with volunteering. They'll leave work and then they'll start volunteering, and all of a sudden they're on boards and they're running programs to serve their community. And they unintentionally created a job that has as much responsibility as the old one. It just doesn't pay anything, but it's for service. This actually reminds me of a conversation I had with the gentleman, Michael, today, who is a client. We were talking about work and when to retire and do we accelerate the retirement plan? And he phrased it well. A lot of times when we leave full-time work, it's not the absence of work that we're desiring. A lot of it is what we want to leave, at least in this case, was responsibility, being in charge of stuff. You could work the same amount of hours at a Walmart or as a consultant or on a project and have a lot more freedom if you don't have the responsibility of the team getting everything done. That's like a hiss that lives in your life, whether you're sleeping or in the shower or walking the dog or on vacation. And a lot of times that's what we want to escape. Bravo for you, Dennis. You're navigating this transformation very well. And I'm happy to hear it. Now, Colleen has a question on 401k choices. And she has asked, is there any advice on how to choose mutual funds, say in a Fidelity 401k? The number of choices is overwhelming, even with bond funds. Ideas where to go for low risk investments? I need help with my portfolio. So Colleen, I do have some counsel for you. I can't give you advice on where to go for a specific low risk investment because it all depends on the menu that you have. But here's how I would suggest that you approach it. A couple ways. One is, if you look at the menu, generally you'll have what are called asset allocation funds. There'll be moderate allocation or aggressive allocation or conservative allocation. And if you have those choices, those are good, easy buttons to start with, because with one choice, you can buy an entire portfolio of many different funds that are targeting a certain risk profile. So as an example, a moderate allocation fund would likely have about 60% in equities and 40% in bonds. And there'll be a number of different investments that make up each one of those major categories, but you only buy it with one mutual fund. So I think that would be a good place to start, Colleen, is to see if they have just an allocation fund. Now, those are different than target date funds, which you probably have in your menu. So a target date fund, I'm not a huge fan of, but there might be a possibility for you. And what a target date fund does is it says it'll have a year to it, like target date 2025, say. And the date represents the year that you're thinking you're going to retire. And what the target date fund will do is, if it's 2021 today and you have 4 years, it will have an asset allocation of bonds and stocks and cash and such. And then as it gets closer to the target date, it will adjust the allocation, presumably to get more conservative, meaning more bonds, as you get closer to your retirement. So that's not a bad backup. I'm not a huge fan of it, but I'm trying to find these easy buttons for you, Colleen. The third easy button might be that if it's Fidelity, generally they're going to have a questionnaire, which will represent like a risk profile that'll ask you a series of questions. And then based on your answers, it will recommend the menu choices that you should use to get to an asset allocation. I think those 3 ways are a good way to sort of make it simple for you, but I would start looking for a target allocation option and then figure out which one might feel comfortable to you. In terms of a low risk investment, if you have access to a stable value fund within your 401k, that's like a cash-like investment that generally have good yields. So I would take a look at that. Hopefully that's helpful there, Colleen. Now, Doug is asking a question relative to a previous question that we answered on the show. We had a question on the show, I forget how many weeks ago, where a gentleman was asking if he could use his Roth to fund his potential long-term care expenses. And my interpretation of that was that he would invest in his Roth and let that grow a more aggressive portfolio, and that would be his slush fund for his potential long-term care expenses. Doug wanted to know, in reference to this question, why concern himself with a Roth? My understanding is that long-term care nursing home costs are deductible medical expenses. So if funds are taken out of traditional IRAs, thus taxable, your itemized deductions will offset the income. Therefore, basically a non-taxable distributions out of an IRA, potentially. Yeah, that's potentially how it could work, Doug. So I get your point on the deductibility of long-term care nursing home expenses, subject to that percentage limit, which I think it's around 2% right now. Anything above 2%. The only concern I would have there is, one, we don't know what tax law will be in place, say 10, 20 years down the road. That would be a wrinkle to it. But I think either way could work, Doug, is that the core of his question was, couldn't I just set aside some money to grow to help defray long-term care costs? Yes, you can. And if you have a Roth, you could allow it to grow tax-free and ultimately repurpose it. You'd still get the tax deductions, or in your case, you could use an IRA and get the tax deductions if they're still there. I think the core thing is, could you simply set aside some money to help defray the cost? And I think the answer is yes. I wouldn't necessarily say it's a replacement, but I think given the long-term care outlook in terms of insurance right now, I think if you piece together, I'm going to use this portion of my IRA or Roth to help fund potential long-term care expenses. If you put that in and then maybe you attach on using whether it's a reverse mortgage or a HELOC or something like that to access some of those funds and possibly some life insurance to replace the money that you might use so your spouse still has some money left. All those things could work together in some way. We just had our meetup on the State of the Union of Long-Term Care Insurance with an expert, Steve Kane, and the Rock Retirement Club. And it's very clear this is a real problematic issue where there aren't any great solutions yet. Our next question comes from Terry in reference to discount rates. Terry says, I love your podcast and look forward to learning something every week. Well, hopefully you'll learn something more here, Terry. That makes sense. Terry listened to the Retirement Live podcast and then the webinar we did. And Terry thought that this year is especially intriguing by the net present value analysis I used to estimate future value of expenses, liabilities, back to current value to compare them against your financial capital. You should never have seen this done before. It's actually taught in the RMA curriculum. And here's the question that Terry had is, this analysis depends significantly on the discount rate assumed. On your spreadsheet, it looks like it was 4.51%. How did you decide on this value? It's a very good question, Terry, and good catch. So this is in reference to the results webinar that we did in our Retirement Plan Live series in January. And we created a household balance sheet, which essentially looks at retirement planning a little bit differently than the normal retirement calculators that you use. In fact, this approach is the approach that we use in Rock Retirement University, which is part of the Rock Retirement Club, to help people create their own household balance sheet to answer questions. And the way that it's different is rather than looking at your assets, your investment assets, and then trying to project investment returns going outward over a 30, 40-year time frame, rather than look at it from today moving forward, what a household balance sheet tries to do, or does, is it takes all your future spending and income and bring it back down to today. So as an example, rather than say you're going to spend $50,000 a year every year inflation adjusted for the next 30 years and see if your assets can cover that, it takes that $50,000 adjusted for inflation over whatever number of years, and it calculates a value for all of that spending and puts it on your balance sheet as a liability for today, which essentially it is. And so it brings it all back down today. And the logic behind that is that if you're taking investment returns and forecasting forward, well, we know that you can't just use the average because you get all these crazy returns on the high side and the low side, and you don't know what your sequence is going to be. It's a very volatile thing to try to forecast forward. But your spending, although there's some volatility to how much you spend in any given year, it's a much more stable value, especially if you're focusing on your needs. So you end up going to get a little bit more clarity on bringing all of that back down to today's value and representing it as a liability than you are to forecast forward. Conversation for another day. But essentially what we're doing is we're saying your spending for your retirement is a liability on your balance sheet, and you have to use a discount rate to bring it back down to today's value. So this is getting a little bit technical, but Terry, 4.51%, if I recall, because I don't have it right here in front of me, represents the long-term average of long bonds. And so that's the discount rate that we use. Now realize we also are using an inflation rate on every dollar of spending. So the difference between those, I guess, would be the imputed return, which is about 2%. So it's a very conservative way of looking at it. So how do you come up when it comes to discount rates? You're correct. You play with that discount rate. Say, no, it's not 4.51%, it's 5%, or it's 6%, or it's 3%. It changes the results dramatically. I experience this a lot in private investment world when you're dealing with real estate and expectations on how a business is going to do or real estate property. These discount rates can be ways to massage the numbers. So we simply use the long-term average of the 30-year long bond. I think we're using the Case-Shiller. And then while still applying inflation to the cash flows. That's how we determined it. And I think the important thing here, Terry, is not accuracy, because you're not going to get an accurate one, right? The important thing in any financial planning is to have a consistent way of doing things, that you are very wary of changing in a dramatic way. It should be an evolutionary thing, not this one makes sense, so I'm going to update everything. And the analogy that fits best for me anyway is everything we're doing is wrong, right? Because we can't get clarity on how all this stuff works because there's too much incomplete information. The situation's too fluid on inflation, returns, someone's spending, life events, everything. So the important thing is to think of it like a scale, like you're going to the doctor's office and you're stepping on a scale and you're weighing yourself. Now, if you've ever I know you've gone to the doctor, I hope so. If you haven't, turn me off and get there right away. But the doctor's scale, at least for me, always shows me as heavier than my scale at home. I have clothes on. It's the middle of the day. I've already eaten. I weigh myself in the morning. So if I were to measure myself and say track my weight, but I kept using measurements from the doctor's scale, from my scale, from the scale at the gym and so forth, it's not going to give me much good information because all those scales are calibrated differently and they're catching me in a different way. That's very similar to what discount rate you use or what financial planning tool you use. You want to use a tool that's thoughtfully constructed, but then measures in a consistent way. Because I'm going to get more value from a scale or a financial planning tool that is inaccurate, but measuring me consistently than I will from continually to recreate the wheel to find a more accurate scale. And the reason for this is I can track data. So when I measure myself, I feel like I'm making this more complicated than it should be. Here's the basics. If I get on the same scale every day and I log my weight, over time, that consistency of using that same scale, even though it's inaccurate, is going to show me patterns of gaining weight or losing weight. And it's the consistency in the data over a period of time that's going to help me understand where I'm headed and help me make decisions. But if I keep switching scales, then there's no consistency in the data, so the data becomes much less meaningful. So it goes the same way with discount rates, Terry. Yeah, we're using the discount rate of 4.5%, but we're also applying a consistent inflation rate. And if we use that as a scale that we measure each in a consistent basis, it's going to really help you make decisions about retirement. So hopefully that gave you some color, and hopefully I didn't confuse or tune out everybody else. I guess I can take my nerd hat off now. This is a somewhat related question, but not near as nerdy. Charlie asks on a net worth statement, what do you do with tax liability? It says, hey, Roger, regarding the net worth statement, my wife and I have relatively large traditional IRA balances. A net worth statement, yours included, the format we share in a PDF that we given out, you can find it at resources under rogerwhitney.com, has no provision for the tax liability when withdrawals are made. Can you address this? Yes, I can, Charles. So you're right. Let's say you have $1 million in an IRA. You don't really have $1 million if you factor in the fact that you're going to have to pay taxes on that $1 million, which is what Charlie is talking about, right? So it can make us feel much more wealthy than we maybe are. Yeah, I got $1 million there, but if I tried to take it all out today and I'm in the 35% tax bracket, I really only got $650,000. That's not near $1 million. And so Charlie wants to know, why don't you reflect that on a net worth statement? In your long-term planning, Charlie, you are going to want to reflect tax liabilities as you estimate them. On a net worth statement, that's really not its purpose because we don't know what your tax liability is because we don't know when you're going to take the money out. I guess you could make the assumption and put a liability, like I say you have $1 million IRA, you automatically put a liability of $350,000 for the maximum tax rate, probably more than that actually, but I'm just using that number for simplicity purposes. And then you could have it there. I think the problem with that approach is that you're not going to take it all out at once. You're going to take it out in drips and drabs. Perhaps you do a Roth conversion. Perhaps you just do required minimum distributions. And that's too messy to deal with on a net worth statement. A net worth statement is just sort of help you see what you've been growing and what you've been contributing to. So I think it's too messy for a net worth statement, Charlie. Where you do want to account for it is once you've created a feasible plan and figured out your first iteration of withdrawal strategy, how you're going to pay for your life. Let's say you're going to take $50,000 out of an IRA every single year. That's your withdrawal strategy. Now on your cash flow forecast, you can add in the tax liability for each year on that $50,000. So that's why we don't include it on a net worth statement, because it doesn't really address it well. And the purpose of a net worth statement is a little bit more about making tactical decisions than it is accounting for a big tax liability just because it's in a tax-deferred assets. Hopefully that answered your question. Now, let's go set a SMART sprint.
On your marks, get set.
And we're off to set a little baby step you can take in the next 7 days to rock retirement. All right, in the next 7 days, I want you to just think about what is a transformation that you're working towards, or maybe one that you're in the midst of. It's important to think about this. What transformation are you in, or are you working towards? So if I think of myself personally, the transformation that my wife and I are in is we're still in that empty nest where our son lives at home, but he's totally independent and he's going to nursing school. And we're in the midst of reimagining what life will be without that role of responsibility with our children being launched. So that's my transformation. And the reason it's important to think about this every now and then is because when a lot of times you get in these transformations and it just happens. There's no marker. There's no ping that lets you know you're in it. So by acknowledging it and identifying it, now you can start to shape the clay. So that's your job. Figure out what transformation you're in the midst of or that you're about to be in. So next week, Nicole is going to join me on the show, and we're going to share just some details on the listener survey that we did, which was amazing. We're well over 1,000 responses, blown away by that. Next week, we're going to have Nicole on, and we're just going to share a little bit about who we are. So you can get an idea of who listens to the show and who's asking questions so we can all learn to rock retirement together. All right, you go have a great week, okay? Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.